It's a pleasure to welcome our guest speaker this afternoon. Lawrence Schembri has been the Deputy Governor of the Banque of Canada since 2013, and he has served as one of the two Deputy Governors responsible for overseeing the bank's analysis and activities to promote a stable financial system. Dr. Schembri was born in Toronto, and he received a bachelor's from the University of Toronto, a master's from the London School of Economics, now called London School of Economics and Political Science. I'm a political scientist, so I have to plug that in, and obtained his PhD from MIT. He taught economics at Carleton University until 2001, reaching the rank of associate professor. He is the author, co-author, editor, or co-editor of some 17 books, I think I counted, and many peer-reviewed articles ranging from monetary policy to economic governance. Dr. Schembri joined the bank in 1997 as a visiting research advisor in what is now the International Economic Analysis Department. And in 2001, he was appointed research director in the same department and became chief of the department in 2005. His published research has focused on exchange rate and monetary theory, as I mentioned, and in open policy in open economies. Today, we are going to hear him speak about historical pivots and future prospects for Canadian exports. Please help me in welcoming Dr. Lawrence Schembri.
Thank you, Marco, for the very kind introduction. It's a pleasure to visit Halifax. I've been here a couple times already this year, and I really enjoy coming back. And I really like to thank the Atlantic Institute for Market Studies for the opportunity to speak here today. The research papers you publish on economic and social issues are thoughtful contributions to the public discourse. On a personal note, Halifax has been an important point of entry for newcomers such as my mother, who landed here at Pier 21 in April of 1953 as a 23-year-old immigrant from Germany. And she's resided and contributed to Canadian society ever since. So if you have a chance to visit the Pier 21 Museum, I visited last spring, and it was a real treat. So it's a jewel of a museum to have here in Halifax. So since its founding in 1749, Halifax has served as a critical point of transit for Canadian trade. The city has supported the growth and evolution of Canadian exports, from the early trading of fish and fur in sailing vessels to modern consumer industrial goods in huge container ships. Mon discours d'aujourd'hui porte sur l'évolution et les perspectives des exportations. Quels enseignements tirés de l'histoire des exportations canadiennes peuvent nous aider à mieux comprendre notre bilan récent au chapitre des exportations et les perspectives d'avenir? Cette question est très importante aujourd'hui, étant donné le redressement décevant de la demande mondiale et des échanges du Canada depuis la récession. As I said in French, my speech today is about the evolution and prospects for Canadian exports. In particular, what insights can we draw from the history of Canadian exports that will help us better understand our recent export performance and our prospects for the future? This is an important question today with the disappointing post-recession recoveries in global and Canadian trade. Canadian exports have grown by 4% per year since the recession, half the rate of 8% we experienced following the recessions of 1981 and 1990 and 91. Now, to understand the benefits we derive from exports, it's useful to begin with the concept of comparative advantage, because that helps us understand the sources of trade. Now, countries will produce and export those goods and services that they're relatively more efficient at producing, either because they have better technology or they have relatively more of the needed inputs. For example, in Canada, we have abundant natural resources, so we export many products or commodities related to natural resources. And obviously, the many examples we could point to: lumber, wheat, and oil. Now, we gain from trade because we specialize in the products that we're relatively better at producing. For example, Canada exports lumber to China, and in return, we import clothing from China. So as a result of that specialization, productivity in both countries will generally increase when trade occurs. And we know when productivity increases, that results in higher standard of living. So in simple terms, Canadians benefit from trade via two channels: an increasing volume or quantity of exports, or a rising relative price of exports to imports, which we, as economists, normally call the terms of trade. And why is that the case? Well, because it allows us to buy more imports, either for consumption or investment. So we generally use exports to pay for imports. So let's turn to a brief outline of my talk. First, I want to give you a brief overview of the history of Canadian exports, and in particular what economic lessons or observations we can draw from that history. Second, we'll focus on our recent experience since 1988 to better understand the key forces driving Canadian exports. I think the experience since then is insightful in helping us understand where we are today. Third, we'll take a look at our outlook for exports, and because the outlook for exports is a critical element of our projection for the Canadian economy, and therefore it is important for determining our inflation outlook and guiding our monetary policy and interest rate decisions. As many of you know, our goal for monetary policy is to achieve low and stable inflation. In particular, we aim to achieve 2% inflation on a sustainable basis within a reasonable time horizon. So let's now step back and consider some economic history. In particular, what are some key historical observations we can draw about our exports? So this chart here simply shows the sum of our exports and imports, the green line, relative to GDP. And you can see that for most of the 20th century and before that, that sum of imports and exports was roughly 40% of GDP. Since then, we've seen a dramatic increase, almost towards 60%. So the importance of trade, Canada has always been there, but it's actually increased recently. So we'll think about why that's the case. Now, this ratio is actually the highest in the G7, except for Germany. So we're definitely very dependent on trade. And you can see that the two other lines, the red line for exports and the blue line for imports, have typically moved together over time. So it comes back to the point I made earlier that we generally use exports as a means for paying for the imports we like to consume. Now, since the early 1990s, about 1/3 of Canadian GDP has been exported. And as I mentioned, this elevated share shows the importance of exports to the Canadian economy. And what I want to stress today, it really underlines the need for exports to continue to strengthen in this post-Great Recession period to put the Canadian economy on a sustainable growth path. So let's now examine the sort of determinants that affect the characteristics of our exports. So what I have here in this chart is just a simple analytical framework to give you a paradigm to think about exports. And when we think about exports, there's a number of characteristics we want to take into account. We want to take into their volume, the actual physical size of the exports, their value, their composition, and their destination. Now, there are various outside factors that influence those characteristics. And on the one side, we have the rates of growth and stage of development of our trading partner countries. For example, the United States, and we'll come back a lot to talk about the United States because our proximity makes the United States an important trading partner for us. But also, in recent years, what's important for us is competitors in third markets. And we've seen a lot of entry of emerging market countries into the United States market. So that's an important driving factor. Now, and on the other side, we have sort of what I call external forces or external shocks, and they include trade policy, technology, and preferences. Now, some of those external forces actually work through commodity prices and exchange rate, and that'll be a recurring theme today because commodity prices and exchange rate are an important variable to understand the Canadian economy. So let's now turn to some of the details about the history of Canadian exports. First, let's consider their composition. So this chart shows a decomposition of exports by type since Confederation. So before the 20th century, we exported what we produced on our farms, agricultural products, those are in blue, and extracted from our forests, wood and other products, and those are shown in green. Now this pattern continued until the early 20th century, when other commodities, which is shown in yellow, such as iron ore, nickel, and copper, became more prominent. Now the two world wars in the 20th century accelerated two important trends: the move from rural to urban life, and mechanization and electrification. Now these trends facilitated the transition to an industrial, export-driven economy based on new commodities, such as oil and gas, which is the purple region, which was first discovered largely in Alberta just at the end of the World War II, and also other manufactured goods, which are shown in gray. Now, what was the most significant development after World War II? Well, it was a wave of trade liberalization. And that trade liberalization began with the General Agreement on Tariffs and Trade, which was, the first round was signed in 1947. And there was a series of rounds subsequent to the one in 1947, and that led to a seven-fold increase in world trade between 1948 and 1973. And that impact is continuing. I mean, there's been a number of rounds, and so that's been a real force to affect world trade. Now, the other thing that's more specific to Canada is the Canada-U.S. Auto Pact, and that was signed in 1965, and that liberalized trade between Canada and the United States in automobiles and auto parts. And you can see that those commodities in red greatly expanded after the Auto Pact was signed, because that pact gave Canada a share of the North American market. And so Canada was allowed to specialize, increase its productivity, and have the ability to export autos and auto parts. So now let's turn to a different sort of decomposition, one about in terms of destination. And so that's shown in this slide here, and we're starting after World War II. And you can see after World War II that most of our exports were destined for the United Kingdom and Europe in green, and also the United States in blue. Now, after the first GATT agreement that I mentioned, the United States and subsequent trade agreements, the United States steadily rose in importance as a destination for our exports. And I'll come back to this point in a moment. But that increased over time. And in recent decades, we've seen an increase in shares of exports going to China in red and Mexico dark blue, while the share of China of our exports going to Japan initially increased but has recently declined. And so what I'd like to draw from these observations are three, I think, important lessons. First, exports have been critically important to our economic development. Second, we've been able to flexibly adjust to shifts in demand for our exports and various global shocks, including new technologies and trade policies. And third, we've been able to sustain our economic success by developing new exports and new markets. Now, in Nova Scotia, there are a number of examples I could draw upon to illustrate this, and I think two fine examples to recognize the resilience of our exporters. One is the lobster industry here in Nova Scotia, which saw its traditional export markets collapse during the Great Recession, but since then has been very successful in developing new markets, particularly in Asia and particularly in China. A second example is really the Port of Halifax, which has engineered a great turnaround in its prospects. In the first 6 months of 2016, it led all North American ports in container traffic growth. And the recent increase in cruise ship visits to the port in 2016 helped to boost an already strong tourism season that Nova Scotia is enjoying. So those are two examples of the type of adaptability or flexibility that we've been able to experience here in Canada. So let's look at our recent export experience. And what I'm going to do is divide the period since 1988 into three phases and consider each separately, because I think there's different factors that were predominant forces during each of those periods. And I think each of those factors are relevant when we look at where we are today. So the first phase we want to look at is really 1988 to 2002. And our experience is shown in the shaded area here. And basically the blue line shows the rate of growth of exports on an annual basis. And the red line shows the share of exports in GDP. And you can see that, over the period that 1988 to 2002, exports grew very strongly, almost 10% per annum. And at the same time, the share of exports as a percentage of GDP increased steadily over that period. I mean, approaching like almost 40% by the end of the period. So this was a period of very strong export growth in Canada. And we want to sort of drill down and understand, why did this happen? And the next slide sort of looks at two important events in that history over the period. The first is the Canada-U.S. Free Trade Agreement in 1988, and then the NAFTA agreement that expanded the free trade agreement to include Mexico. Now, so those agreements increased the share, again, the United States is in blue, increased our exposure to the United States. Also helping us to increase our exposure was the fact that during this period, commodity prices were relatively low, and so the value of the dollar was relatively low. So again, another important aspect of what we'll be talking about today is that commodity prices and the value of the Canadian dollar generally move together. And so, as a consequence of both the trade liberalization agreements as well as the value, the lower value of our dollar, our exposure to the U.S. market went up dramatically. So it went up from about 70% in 1988 to almost 90% in 2002. And the other important aspect in terms of explaining the export growth is not only did our exposure increase to the United States, but the United States was one of the fastest growing countries in the world at that time. So this slide shows this. So the blue line shows the share of U.S. share of world GDP, and the red line shows the U.S. share of world goods imports. And you can see that, especially over the second half of that period, the U.S. share of both global variables was increasing steadily. So not only were we increasing our exposure to the United States, we were also being exposed to one of the fastest growing countries in the world at that time. Now, this strong U.S. demand over this period boosted the production and export of a wide range of Canadian goods and services. So what kinds of goods experienced the strongest growth over this period? So let's turn to that now. And one of the things that grew most rapidly over this period were non-commodities, in particular manufactured goods. And so if you look at the breakdown here, the red line shows machinery and equipment, and that experienced very strong growth throughout this period. And then consumer goods in green also experienced strong growth. Now, interestingly, motor vehicles and parts, the blue line, did not grow very quickly because they had already been liberalized by the Auto Pact some 30 years earlier. So that's why its growth rate was not very strong, because it was already operating at a fairly high level. As a consequence of these trade agreements and our exposure to the United States, Canada became very diversified throughout the 1990s in terms of the type of goods. So to sum up, the rapid growth in exports over this period were driven by three factors. First, trade liberalization with the United States and Mexico that increased the access of Canadian exports to those markets. Second, the low value of the Canadian dollar, which increased the price competitiveness of Canadian goods and services in the U.S. market. And third, the rapid growth in the U.S. economy and their demand for imports. Now, this is an important set of explanations, because I think this is relevant when we look ahead to where the Canadian export outlook is going. that we have some of those factors in place: trade liberalization, lower value of the Canadian dollar, and also rapid growth in the U.S. economy. So I think that's a set of lessons we should keep in mind as we consider the outlook in a few minutes. So the second phase I want to talk about is really from 2002 to 2008. And again, so this is the phase in the shaded region here. And what you can see here again is the blue line, remember, is the annual growth rate of exports. And so during this period, on average, it was roughly 3%. So there wasn't a lot of rapid growth in terms of volume of exports. But what I'll explain in a moment is that the value of our exports increased tremendously over this period, and I'll come back to that. The other thing is that the share of exports in GDP also declined somewhat. So this is it's a very different phase than the one I just spoke about. Now, how do we really explain that those observations? And really, the one word answer is China. And so I'll explain that in a minute, how China had such an effect on the Canadian economy. So China joined the World Trade Organization in 2002, and as a member of the World Trade Organization, gained access to the markets of all member countries of the World Trade Organization. At the same time, all the member countries gained access to China, but China had a strategy to really foster growth by building up its industries, and in particular its export industries. So let's explain the impact of China on the global economy. So as I mentioned, as China entered the World Trade Organization and started exporting to other countries, it really became an industrial powerhouse, and as a consequence became a large consumer of natural resources. So you can see here, I've plotted the global share, China's share of global consumption of a number of different commodities: oil, coal, aluminum, copper, nickel, and zinc, and over different time horizons, over different time periods. So the red bars are 2002, the blue bars are 2008, and the green bars are 2015. And you can see that over this period, China's share of global consumption either doubled, tripled, or quadrupled. And so this was a huge shock to global commodity markets, because you had this large increase in demand, and not surprisingly, just like Economics 100 would tell you, commodity prices rose dramatically. And so you can see this in the next chart. The red line gives the Banque of Canada Commodity Price Index, and you can see how rapidly it rose over that period until the Great Recession struck in 2008, 2009. So it went up dramatically, and at the same time, the value of our dollar went up fairly significantly. I was at the Banque of Canada that period, and I know that it started, in 2002 was roughly 62 cents to the US dollar, and then at some point it went well above parity to almost 107. So that was the driving force for that appreciation, was the increase in commodity prices, and the increase in commodity prices was really driven by Chinese demand. Now, that appreciation of the dollar caused a lot of economic adjustment, both within Canada and abroad. And so in Canada, the commodities sector expanded, and the non-commodity sectors shrank in relative terms. Now abroad, Canadian firms lost market share in the U.S. import market. Canadian firms in particular, the ones that were non-commodity exports, and I'll come back to that in a minute. China and Mexico and other emerging market countries gained market share. So many of the gains that we had achieved in the previous period were reversed because of the appreciation of the Canadian dollar. So what happened, just to summarize, is exports didn't grow very much, but the value of our exports really increased. And so our terms of trade, as we like to describe it, went up fairly significantly. So now in the Great Recession of 2008-2009 that was sparked by the global financial crisis, we had a sharp drop in commodity prices and also the dollar. But what's interesting is that the commodity price movement was really a V-shaped. It came back fairly quickly, and so did the Canadian dollar. And that's an important observation for understanding where we are today. So let's turn to the last episode of our discussion, which is the period since the Great Recession. And what we see here is that we have this fairly rapid rebound in export growth So the blue line comes back quickly. But the rate of growth over the period, just as mentioned, is roughly 4%. And the share of exports as a percent of GDP has essentially remained relatively flat or has increased slightly. And so this period is very different from the period we just saw. And so how do we understand what's going on now relative to what we experienced in the previous period? So there are a number of explanations for what's happened since the Great Recession to Canadian export performance. And some of those factors are clearly global that also have an impact on Canada, and they're also Canada or Canadian specific. So let's first look at the global factors. So the blue line shows the share of trade as a share of global GDP. And you can see that prior to the Great Recession, trade was increasing almost twice as fast as global GDP. So it was really a rapid increase in trade that was taking place prior to the crisis. And then after the crisis, during the recession, it came down, and it's come back, but it hasn't returned to its previous path. It's essentially flat. So the question becomes, well, why has that happened? Why haven't we returned to the previous path that we saw before the crisis? And I think there's a number of explanations that I think are also relevant, global explanations that are also relevant for Canada. First, business investment at the global level has been weak. And we know that business investment is very intensive in traded goods. So when we see trade going up, it's often driven by business investment, in particular things like machinery and equipment, aircraft, things like that are very actively traded. And so the composition of trade has been, business investment generally has been weak. And then when we see GDP growth, it's not been primarily in business investment. So Canada has also suffered because U.S. business investment growth since the crisis has been relatively weak. The second explanation for why we haven't returned to the previous path in terms of GDP, trade to GDP at the global level, is really the pace of trade liberalization has either slowed or reversed. As I mentioned, China joined the WTO in 2002, and that was a significant increase in trade liberalization. And since the crisis, since the recession, we've seen a number of protectionist measures being put in place. They've increased fairly significantly. The WTO, the World Trade Organization, measures that estimates that there have been 1,500 measures put in place since the Great Recession in G20 countries alone. Now, Canadian firms have complained to us about the Buy America policy. Some of that's been retracted, but it was an issue for Canadian firms. So now let's turn to Canadian specific factors that we want to consider for explaining the relatively weak performance of Canadian exports in the post-recession period. So when in the 2000s, I explained when the Canadian dollar was appreciating, and during the Great Recession when demand collapsed, we lost export capacity in Canada, and particularly in non-energy or non-commodity goods. As many exporting firms exited from Canada, over this period we lost about 9,000 exporting firms. So those are essentially have disappeared, and most notably our auto industry was very severely affected. It was the biggest adverse shock the auto industry had experienced in its history. Second, Canada lost U.S. market share, as this chart shows, because of a loss of competitiveness. So you can see that Canada's, what the height of the bar represents is nominal imports, nominal U.S. imports. And you can see that Canada's nominal share of nominal exports to the United States has really essentially remained fairly flat over an extended period. I mean, it went down slightly during the recession and came back up. But you can see that other countries have really increased the amount of their exports to the U.S. market. In particular, Mexico in blue increased steadily. China, again, increased steadily. And other countries have also increased their share of U.S. imports. And many of those countries are emerging market countries. So as a result of these shocks, both the shock in terms of loss of productive and export capacity and the loss of U.S. market share, many Canadian firms at this point are reluctant to incur the sunk costs of investments to re-enter the U.S. market and to expand their export capacity. Because to enter the market and to increase your production really takes investment, and some of that is essentially sunk. It's irreversible. So they're only willing to do that if demand is sufficiently strong, much stronger than it is now. And so we see a number of firms holding back. And these firms have also voiced concerns about protectionism, regulatory uncertainty, deficient infrastructure, and high electricity prices. So these factors as well are holding back the decisions of Canadian firms to re-enter export markets they've lost and also expand their production capacity. So in summary, what have we learned from this episode? Well, the strong post-crisis recovery in commodity prices and exports, especially energy, helped mask the effects on the Canadian economy of the slowing in global trade and the losses in export capacity and competitiveness. Now, when the commodity price collapsed in 2014, that exposed those structural weaknesses. So let's talk about that now. Let's turn to the impact of the commodity price decline and the prospects of our exports. So what I've shown in this chart is different types of exports. Services are in green, and that they're measured on the left-hand side axis in billions. And then I have commodity exports in blue and non-commodity goods exports in red on the right scale. And you can see that, now just keep in mind that services are about 15% of total exports. And you can see that generally export, and I'll come back to this, services have held up relatively well. They didn't really decline that much during the Great Recession. However, we've had some recovery in both commodity exports and non-commodity exports, but they've been fairly flat, as I mentioned. And part of the reason when we think about commodity exports, you can think about, let's go back a little bit, a few slides to the price of commodities. Okay, so here we have the price of commodities in red, and you can see how sharp the decline was sort of starting in 2014, mid-2014. Commodity prices have gone down dramatically, and with the decline in commodity prices, the Canadian dollar has depreciated. So we're in a different set of circumstances now since 2014, and this decline is essentially reversed a lot of the increase we saw from 2002 to 2014. Now, why did this decline occur? Well, supply, as you learn in many of your economics courses, supply eventually caught up to demand. That we had very strong demand from China, which was sustained, and so supply in many countries caught up. And the classic examples that we often point to is U.S. shale oil. U.S. shale oil came on in earnest in the last few years, and that helped increase the supply of global supply of oil, and that drove down the price. Now, this price decrease has spawned a complex adjustment process within the Canadian economy as investment and employment adjust away from the resource sector in Canada towards the non-resource sector. As a result, the exporting landscape is transitioning once again. The growth in non-commodity exports has been supported by the depreciation of the dollar since 2014. However, over the past year, and you can see that in the downward dip there, goods exports have declined fairly significantly. I mean, it's hard to see because of the scale, but if you look at the first half of this year, goods exports have fallen by in the neighborhood of 20%. So it's been a sharp decline. Now, there are a number of factors that can explain that, the weakness in the United States, but we think some of that shock that we've experienced over this year is permanent. And so we've revised our outlook. If you look where we are, the dotted lines reflect our projection outlook. And you can see that we've revised down our outlook for commodity as well as non-commodity goods exports. And the reason we've done that is really twofold. The U.S. economy is still expected to gain momentum going forward, but the composition of U.S. growth will be less favorable for Canadian exports. In particular, we've revised down U.S. business investment and residential investment. Both will grow more slowly. Second, the softness in these export numbers that I showed, especially for non-commodity exports, has led us to believe these structural factors that I just discussed in a moment, the loss of export capacity and the loss of market share, are actually having a more pronounced effect on exports than we originally believed. And so this is a subject of ongoing research, but we feel that the kind of effects I was talking about that we often, economists like to call hysteresis effect, where there's a very persistent effect on exports, are more pronounced than we anticipated. And the other consideration is that the depreciation of our dollar, which has taken place since 2014 with the decline in commodity prices, is likely having a smaller effect on price competitiveness of our exports than it has in the past, because some of the currencies of the competing countries that we compete with in the U.S. market, for example, Mexico and Brazil, have depreciated by more than the Canadian dollar, so that we haven't gained as much competitiveness as we might have believed. However, as I come back to now, is really service exports are continuing to grow relatively strongly, and that reflects our ability again to pivot in new directions and to enhance and diversify our export performance. So, as I mentioned, service exports represents about 15% of our total exports, and you can see that commercial services in blue has increased steadily since 1990. These include financial management and engineering, as well as IT services. So those have increased fairly steadily. Exports of travel services, which are in green, and transportation services in red, have also risen. And travel services exports, in particular tourism, are particularly sensitive to the exchange rate. And so the lower value of the dollar we've experienced recently has really helped boost tourism exports in Canada, and I think Nova Scotia is enjoying a banner year as a result of the boost in demand for tourism services. Now, the expansion in services exports are driven by a number of developments, including trade between parent and foreign affiliates, and the trend towards outsourcing of standardized services. There are other explanations as well. Technological breakthroughs that we're all familiar with, the development of the web and digital economy, and shifting tastes as households tend to spend more on services as their incomes increase. The last thing I want to stress is that Canada is really well placed to provide and export these types of services given our highly skilled workforce. So what about the markets for our exports, our service exports? And here I've just plotted, just to give you a sense of the difference between goods exports on the left and services exports on the right. You can see that services exports are generally more diversified. Part of the explanations is just generally that it's less costly to export services exports than goods in some situations, and so they can be delivered at lower costs. So we also, as you can see from the right-hand pie chart, we export services more broadly to the rest of the world, which includes a lot of emerging market economies that are growing relatively quickly. So let me wrap up. So the key elements of our outlook going forward are stronger U.S. and global growth, the lower value of the Canadian dollar, and potential trade agreements. We've already seen that CETA has reached a certain level of approval. I know there's still some distance to go. And there's also the Trans-Pacific Partnership, TPP, that's under consideration at the moment. And that's led to greater and more diversified, that will lead to greater and more diversified trade. So what are the key messages that I want to leave you with? First, the recovery in global demand since the Great Recession has been what we like to describe it as serially disappointing due to private and public debt deleveraging in advanced economies and this elevated uncertainty due to economic and political shocks. These global considerations explain roughly half of the weaker than expected performance in Canadian exports over this period. For the rest, as I mentioned, we are continuing to examine a range of structural factors, including the loss of export capacity and market share, and persistent competitiveness challenges. Concernant l'impact du choc récent sur le prix des produits de base, il y a plus en plus de signes qui donnent à penser que l'activité dans le secteur des ressources est sur le point de se redresser. Il y a bonne raison de croire que les exportations canadiennes continueront de s'améliorer à mesure que les économies américaines et mondiales gagneront en vigueur. As I said in French, the Canadian economy has made good progress adjusting to the commodity price shock, and there are growing signs that economic activity in the resource sector is bottoming out. In addition, there is good reason to believe our exports will strengthen further over the medium term as the U.S. and global economies gain momentum. In the longer term, what does economic history tell us? Well, Canadian economic prosperity has been driven fueled by export growth. Firms over time have adapted and adjusted their exports flexibly or pivoted in response to external forces. And this flexible adjustment that we've enjoyed here in Canada reflects a number of factors. First, our strong legal and political institutions. Second, our commitment to property rights and market forces. And third, our commitment to appropriate economic policies, including sustainable fiscal, financial, and monetary policies, and also to trade liberalization. Canada's commitment to trade liberalization has supported economic and employment growth and rising living standards. New trade agreements, however, we know can result in adjustment costs for certain firms and their employees. Therefore, it is incumbent on policymakers to buffer this transition by ensuring adequate safety nets for workers and facilitating retraining and relocation. In summary, Canada has one of the most diversified trade-driven economies in the world. The global economy exposes us to shocks, but also to opportunities. Historically, Canadian exporters have demonstrated the ingenuity as well as the determination to overcome the challenges and seize the opportunities. We should have confidence that ships will continue to sail out of Halifax with our goods and commodities, and that clients around the world will continue to value our services. So thank you very much for your kind attention. I would welcome any questions or comments you might have.
This is their first question. Okay. If you could just prompt people, we'll go around and collect any further.
Okay. The question I received is, yesterday Ames released a study showing a sharp decline in private sector capital investment for the Maritimes in the last decade. What does this mean for our export outlook? Well, this is consistent in some ways to the story I was just explaining, that we've lost export capacity over the last decade, and I think that's been borne to some extent by the Maritimes. And it is a process of adjustment. I mean, one can't underestimate the size of the shock we've gone through. I mean, we had this very large appreciation of the Canadian dollar, in part driven by commodity prices, and since then, a lot of that's reversed. So it's been a lot of churn that's taking place in the Canadian economy, and so that's the complex adjustment we like to talk about. And so, I mean, the Maritimes, like other provinces, are going through this adjustment, and so I think that's holding back investment in the Maritimes. The other thing is I mentioned earlier, is just the level of economic uncertainty. When you have that degree of adjustment taking place, firms really need to be confident that demand for their product will be sufficiently strong to justify them taking on board the sunk cost investments to expand their productive capacity and as well as to enter new markets. So the combination of the large shocks we've experienced, coupled with the fact that there's been a lot of uncertainty, especially at the global level, that is sort of holding back the adjustment process. So that I think is restricting firms' ability to export because of the shock that we've experienced, coupled with the fact that there's a lot of uncertainty and really slow growth at the global level. The second question I have is, what do you think the effect of growth of e-commerce through sites like eBay and Shopify, which make it easier for small and medium-sized businesses to access export markets, will have on Canada's exports? That's an excellent question, and I think we're looking at this very closely along with StatsCan to look at the effect of how we measure these services exports in the future. We think they're very important, and at this juncture in time, we think they're being underestimated. And so I think there's ways we can do that. And I think the other point I want to make in response to this question is the fact that we just released a staff and discussion paper today that did a survey of IT firms. And if you look at the responses to questions in that survey, most IT firms that are engaged in exporting IT services are very positive about the future. So I think your point is exactly right, that this is a great opportunity for Canadian firms to basically export abroad. So, and I agree entirely that because of the digital economy, it makes it much easier for these small and medium firms to access it. It's just less costly to get their presence out there in global markets. So thank you for that question. I noticed that I noticed one of our own export services is government. Nova Scotia has a lot of government partners at the municipal level. How can we take advantage of this attribute? Well, I think that's, I was talking to Colin Dodds just in a moment, about education services. And clearly, that's a comparative advantage Canada has. I know that Colin and others have been leaders in terms of attracting foreign students to institutions of higher learning in Nova Scotia. But I think that's something that is going on in other provinces, maybe not to the same degree, but it's something that we should really take advantage of this opportunity, because a lot of students around the world want to be educated in English. Canada has excellent institutions of higher level learning, and indeed they have excellent institutions of elementary and secondary education. So there are more and more students coming to Canada to take advantage of the education that we offer. So I think there's really more opportunities there to take advantage of such advantages that we possess. So what can individual young Maritimers do to ensure a prosperous economic future for the region? Well, that's a general question. I mean, I think one obvious response for individuals is to continue to build your human capital. I mean, human capital is an important source of people's ability to be employable and to generate wealth. I think that's one of the things people underestimate in terms of the returns to investment. I think a number of economists are now realizing, when we talk about business investment, which is traditional types of investment in plant, machinery, and equipment, expected returns are lower because productivity growth has generally come down recently, but the returns on human capital investment have recently gone up fairly dramatically. And so I think that continuing your education and continuing to develop your own human capital in terms of your ability to produce goods and services that are marketable not only in this region but to the rest of the world, I think are the best approach you should take. Okay, so Nova Scotia.
Here, and then we'll conclude.
Okay, wow. Nova Scotia wants to increase its GDP by 10% on the back of CETA. How does it do so? Well, 10% is quite an ambitious goal. I mean, generally speaking, the estimates we've seen, this is for Canada as a whole, the estimates we've seen is somewhere in the range of between 0.4 and 1% on the level of GDP by sometime in the 2020s. So 10% of Nova Scotia GDP is really a stretch. I mean, I think that Nova Scotia's made strong efforts to develop new products and develop new markets. I mean, one of the things I've learned, I did an outreach visit with Colin Dodds in the spring, and we learned about a lot of firms that are developing new markets. The wild blueberry enterprise here in Nova Scotia, I think, is a great example of ingenuity and innovation. in Nova Scotia, and that's what's needed. And I think that's been true throughout Nova Scotia's history. Is there's been a number of fine examples of innovation, ingenuity, and determination to break into export markets. And so, and for Nova Scotia to continue to do that, I think it's really creating the right environment that I spoke of for this type of activity to take place. Okay, so have we reached the end of monetary policy to stimulate the Canadian economy? Well, I think the governor has spoken to this point in the past, in the sense that he did give a speech last year in December where he explained that we do have other tools in our toolkit to stimulate demand other than the interest rate. Economists, or central bank economists, like to call those non-conventional monetary policy tools, but those are still present, and we can still use those if needed. But he's also noted that the mix of policy in Canada is now moving in a direction that's better balanced between monetary policy and fiscal policy. And so I think achieving that better balance is really important for us, because it relieves some of the pressure on the central bank to boost aggregate demand and reach our inflation target. So the next question is thoughts on Chinese debt levels and the productivity of what their incremental debt is being used for, and implications for Canada. Well, we've identified it. We have two main publications at the Banque du Canada. One is the Monetary Policy Report that really explains our economic outlook and our rationale for our interest rate decision. And our second publication is the Financial System Review, which looks at risks to the global economy. And in both of those publications, we've identified China and other EMEs as a potential downside risk. And the reason for is that China is going through a significant transition. As I mentioned, China developed by being an export and industrial powerhouse with a lot of investment. And that type of approach is not sustainable forever. And so what the Chinese authorities are trying to do is manage a transition of their economy towards one that's more based on domestic consumption as opposed to investment in exports. And that's a difficult thing to do. Chinese economy is very large, and so that transition is hard to do. And so what they've tried to do is use stimulative policies and encourage credit expansion. And there's a limit on how much that can go. I mean, I think the question is a good one, because there's really how much can you push that kind of stimulus, and I think that's the vulnerability. I mean, the Chinese authorities have shown great ability in the past to manage difficult situations, and the hope is that they will continue to do that. But there is a risk that it's very difficult for their economy to transition from one that has been so heavily dependent on exports to one that's based on domestic consumption. So there is that transition that is very difficult to manage, especially in an economy that's kind of a mixed, directed, market-oriented economy. And I think that makes it so much more difficult. So is there an ideal level for the Canadian dollar to the US dollar? If so, is that amount, what is the amount or range? Well, the Canadian dollar, as I mentioned, is driven by a number of forces. The most important is really commodity prices. Commodity prices explain a large part of the movement in the Canadian dollar. And our policy at the Banque du Canada is really to use monetary policy to achieve our inflation target and allow markets to determine the value of the exchange rate. And clearly, the value of the exchange is ultimately determined by the relative price of what we produce. What we produce, and so if commodities are going down, the economic logic holds that the value of our exchange rate could go down. Now, my view is that our outlook for commodity prices is relatively stable. So, other things being equal, we expect the Canadian dollar to stay in that range because we don't see any large movements in commodity prices going forward. So. And it has been in the 75-cent range for the better part of this year. So I think if commodity prices remain relatively stable, so will the Canadian dollar at the current level. Second question, do service exports increase employment? How does the effect Where do we focus our trade? Okay. Well, service exports have increased employment. One of the interesting aspects of services in Canada, if you look at the labor force survey, the services industries, not necessarily just the export-oriented service industries, their employment has increased by 250,000 since 2014. And we've lost about 70,000 jobs in goods-producing industries, and they're primarily commodities. So we've seen a lot of growth in services. And many of those services are ones that we do export. So there has been increases in employment. And those are, and some people sometimes think of services as being, well, it's relatively low-skilled jobs. But the increases we've seen are actually in relatively high-skilled jobs. So that means that on net, wages in the service sector have been increasing because at the margin, those jobs have been better, higher quality jobs. And where should we focus our trade? Well, the example that I spoke about in terms of the IT sector, that sector is really experiencing positive growth. You can look at our survey that we published today, but that seems to be a sector that's really a promising one, and it holds a lot for our future. So I guess I should stop there. So thank you very much for your attention, your questions. I appreciate it. And I'm delighted to be the person to kick off the Friends of AIM.